Hello, everyone, and welcome to my Q3 portfolio update for my eToro Rubymza portfolio. I'm Heloise Greeff. I'm the person behind the Rubymza portfolio. If you haven't met me before, thank you so much for joining. And I look forward to answering all of your questions in the following update. Before we get going, just a notice that this is purely for educational purposes. It's a review of my own portfolio, and you should always seek your own investment advice. So, the agenda for this call would be a brief introduction of me, the portfolio. We'll go over the investment strategy and how that has sort of adjusted to the market as things keep changing. Then we'll look at a market and portfolio review for the last quarter, which is for Q3. And finally, we'll look at the market outlook and portfolio positioning going into the last quarter for this year. So without further ado, as I said, I'm Dr. Heloise Greeff. I am originally from South Africa, but came to the UK about 10 years ago. I did my biomedical engineering and MBA at Oxford University before coming back to Oxford to do a PhD in machine learning. I've since have a couple of patents and publications in that field. However, for the last 2 years, exactly now, I have been a full-time popular investor on eToro, which has been, an amazing journey. I've learned a lot from you, as well as it's been great working with eToro more closely. And yeah, I have over 175 people following my portfolio. I've had more than 20,000 copiers since I got my first copier in more than 6 years ago now. And I've had more than $50 million in assets copying the portfolio since its inception. My own financial journey, as I said, started first in 2009. I am an engineer by training, and I came to eToro, like many of you, to try and take control of my own financial circumstances, seeking financial freedom. I joined eToro in 2016. I liked the transparency of the platform. I like to be able to engage with other investors. But more than just engaging, I think it's the transparency that pulls me. You can really see what people are doing along with what they're talking about. So that's what brought me to the platform, but has also kept me on the platform. And in 2018, actually, I got my first copier. But yeah, eToro asked me to make the portfolio public, as I was doing quite well. And yeah, as they say, the rest is history. It's been a wonderfully amazing ride since then. I have done a lot of media appearances, including meeting hopefully some of you who are watching this when I attended the eToro events in Italy in September, and I have a few more coming up for the rest of the year. It's always the highlight for me when I get to meet my fellow eToro investors in person, not only because some of you have been copiers for a long time, but more because we have such engaging conversations around the stock market, the portfolio, and so yeah, I really enjoy that. In terms of my portfolio, I have a growth, predominantly long only portfolio. I have in the past taken some short positions, but it's been a very long time since I've done that. So I would say quite confidently that this is predominantly a long only portfolio. And like with many long term portfolios, I do suggest copiers to consider a timeline of at least more than 5 years, but probably closer to 7 years. I know that can be difficult. My own parents also copy me on eToro, and they like to ring me up and remind me about this horizon. So, yeah, I do understand very closely with you what the emotions that can be involved with being an investor in the stock market. I myself have been through that. But one of the things I do pride myself in this portfolio is my investment thesis to keep a low to moderate risk score on eToro. And you'll see later when we look at the performance and the risk exposure, how I've managed to do that consistently. And I'll talk a bit through that when I'm looking at the portfolio. So, in terms of my investment strategy, there are 6 main pillars to my investment strategy. The first layer is what I call the basics. So, this is not me reinventing the wheel, but this is simply me applying tried and tested first principle approaches to investing, which is focusing on long term growth and compounding that growth. The second is to apply very rigorous decision and risk management to reduce the volatility. And that links back to the risk score that I was talking about. And then thirdly is that strong focus on interpreting fundamentals around our current economic environment. And you'll see also why that is becoming increasingly important as the risk curves, the yield curves have uninverted. So we'll talk through that as well. The second layer of my strategy is what is uniquely me. So I have been using bespoke machine learning algorithms as part of my AI assisted strategy on eToro since 2016. To both adjust real time liquidity and manage volatility. And that's purely because I was doing my PhD in machine learning at the time. I was analyzing and predicting failure and deterioration in very complex systems, as well as probably the most complex system, arguably, would be humans, patients. And so naturally, my curiosity led me to see whether I could apply those same tools to my investment strategy. So I have been doing this since 2016. They're bespoke, in house developed, so they're not off the shelf, and we keep adjusting them, retraining them, and updating them as the field is rapidly advancing, as you might know. The second pillar is keeping that strong focus on zero or low fees. As you might know, and I'll pause a minute here to talk about it, eToro has always prided itself on having very low or zero commission. They are unfortunately reintroducing commission for a lot of things, which for a lot of very valid reasons, which I have posted about. Fortunately, that commission does not extend to your copy position. So if I buy any stocks, and you are copying me and you're buying those stocks through the copy position, you're not carrying that commission. So, a great reason, even more so, for why to copy is because those commissions do not extend to your copy position. And then finally, is that strong focus on hive mind megatrends and trying to establish where we can see those high growth disruptive areas and trends. As we know, the world is currently rapidly evolving. So, without further ado, let's dive into our Q3 market review. I can't say anything other than that investors were really treated to a white knuckle ride in this last third quarter. But as we get the final 3 months of 2024 underway, stocks are currently at their records highs, and bonds are solidly in the green. This is something which is both celebrated by investors who have been in the stock market, but it also makes some investors a bit nervous because there has been talk about a potential correction. I won't get into that right now. I'll talk about that when we're talking about the outlook for the rest of the year. But as I said, Q3 was a really tumultuous period for the US markets. And that's because the S&P 500 posted both its biggest one-day slump as well as its best rebound since 2022, following the weak job reports, which stoked new fears of a recession at the start of August. However, these fears were soon dampened after the Fed's rate cut of 50 basis points, which essentially enabled the S&P to post another quarter in the green for its best year-to-date performance of the century, essentially. So yeah, overall, a really good quarter. And if you've been in the stock market for a long time, you'll know that September can be a particularly tricky time for investors and is almost always in the red historically. But this has been very different this year. And so while the broad market goes into its final months of 2024, having resumed its rally, under the surface, the returns look very different thanks to the rotation out of those big tech names, which have been really driving the bull market for most of the year. And the broader market rose throughout July, despite tech stocks running out of steam and returning lower returns. And that really cleared the way for value stocks and small caps to shine as this long awaited rotation arrived, and investors shifted out of the rally winners into the laggards, which we talked about in our last update. So the sort of really brutal sell-off that we saw in August sparked those intense and sort of underlying fears of a recession, and compounding that with the sudden unwinding of big bets in Japan saw the stocks fall roughly 3% in one day. But equities have since clawed their way back into the green and ended the quarter up just over 6%. Although those concerns do persist about the overvaluation, particularly in the tech sector. So, if I have to identify three major points which sort of drove the market in the last quarter, it would be the noisy job data, the interest rate cuts, and the growth, this rotation from growth to value that we saw. And in terms of the jobs data, it it showed an initial cooling, but not quite a crumbling of the labor market that the markets feared as much. And the July and August employment reports, along with this pickup in hiring in September, really helped to sort of soften those concerns that the US economy was sliding into a recession. And jobs data in the fourth quarter are likely to be equally noisy, given the turbulent economic and political sort of events are going on in the country. But on the balance, we do expect the employment rate to stay near 4%. But this weak US labor data really put the conversation around a hard landing thesis for the US economy back on the table, which essentially compounded by a surprise hawkish move by the Bank of Japan, led the VIX, or the volatility index, to touch its highest level since March 2020, which was when we saw those peak concerns around the pandemic. However, overall, I would say that the sentiment improved as the quarter progressed, which helped, which was helped by central banks pivoting, um, and this includes the US Federal Reserve decision to cut interest rates. So, going into the quarter, there was a point where the discussion was no longer whether we would see a cut or not, but rather the size of the cut. And that cut of 50 basis points, along with the Bank of Japan's indication that further tightening would depend on financial stability, has sort of improved over the quarter. And US economic data has also proved to be more resilient than we originally feared, which has helped global equities to rise for a fourth quarter in a row. So, moving on to the interest rate cuts, as I said, underpinning the equity market's rebound in this quarter was the resolutions of months of investor uncertainty over interest rates. And with the inflationary pressure easing, the Fed reduced its target rate by half a percentage point at its September meeting. And at the time, they cited ongoing progress on inflation and attentiveness to a recent cooling in the labor market. As I said, the move really ended a months long investor speculation about the likely path of rates and brought about the end of that really aggressive policy tightening cycle that began back in 2022 as inflation reached its 40-year highs. Investors are now expecting the central bank to continue pushing these rates lower. And even though investors had previously expected a cut of the same size in November, we're now looking for a smaller quarter point easing, according to the bond market data from the CME FedWatch tool. And as I said, investors are really anticipating those rate cuts to be pushed further into 2025. But the additional clarity of the sort of way forward after these months of uncertainty has helped to push the bond market as well further into positive territory during the last quarters. And we finally saw yields beginning to fall in June and July as the rate cuts solidified. And the reduction in the interest rate really played a key role in these returns for both stocks but also bonds. And I would say, despite this cut bringing a lot of optimism, under the hood, there is a lot more going on than what the headline numbers are suggesting. As I said, when the Fed did cut the rates, it was quite an aggressive cut of half a percentage points. And they cited their reasons at the time, but officials are now signaling that it may have rather been a concern about supporting economic growth rather than the stamping out of inflation, which they cited at the time. The final and third sort of major headline for this quarter has been the rotation from growth to value stocks. And as tech stocks struggled, value stocks really took their lead in the third quarter. And we can see in this box style that every quarter, every category ended this quarter in green. And that's a dramatic turnaround from the second quarter when only large blend and large growth stocks saw gains. The largest gains came from a mid-cap blend of stocks, which soared more than 10%, while the large stocks fell to the back of the pack with a return of just 2.2%. And over the past year, however, the category remains really dominant with returns of 35%. You'll see in our portfolio composition, we're not quite fully blended, but we do have some exposure to value, which means our return sort of sits slightly between these two, skewed to that of growth stocks. If we look at the asset class return, as I said, the value stocks really drove this last quarter. If we look at the absolute returns for the quarter, tech stocks returned just over 2.35% for the quarter, but they're still up nearly 51% for the year. If we look specifically in the sector performance, then we'll see the communication services stock performed similarly well. They ended the quarter up almost 8%, and they've retained their 12-month gain of 42%. The biggest losses came from the energy sector, which fell 2.83%, a sector we do have a bit of exposure to. But of the major stock sectors, utilities really led the way this quarter with a gain of nearly 20%, closely followed by the real estate stocks, which returned almost 17%. And this is because both utilities and real estate stocks are sensitive to changes in interest rates. And they both rallied as it became clear that the Fed would ease their monetary policies. So, utilities also got a boost from the AI boom, and particularly the expectation that this newfound progress in the sector will translate into a greater demand for electricity from new data centers, as those processors are quite energy intense. And so, with that, we'll move on to the market outlook for the rest of the year. Despite this roller coaster ride, as I said, the stocks finished the quarter up at nearly 6%. So, as we head into this final quarter for the year, investors are naturally wondering whether this rotation to value will persist. Will the economy hold up? And what will be the Fed's next move in November? And of course, the election. I'll start with the election because presidential election years tend to be a very volatile year for the stock market, as we have just experienced, and it's become, increasingly volatile as we see major parties being more polarized, not only in the US but globally. We've had a lot of large economies have their national elections over this last year. But the question is really whether politics do matter in the long term. And, in short, the answer is no, because if you look at the long-term trend for stock market returns over nearly the last 100 years, regardless of whether it was a Republican or a Democratic candidate that won the election, over the long term, it has not really had an impact on the stock market. There may be some immediate downturn following the outcome of the election as the market sort of readjusts to the new policies. But in the long term, sorry for those egos, but those individuals or those parties are, not outshone by the larger, broader market. And in fact, calendar year performance for presidential elections can be really positive years despite being very volatile years. And so far this year, we are experiencing the same, where the stock market is up nearly 20%. Our portfolio is following closely. Of course, we have this final quarter to get through, but it is so far without, jinxing the rest of the year. There is a strong trend that we're following historically as well. Then I touched on it earlier, but the yield curve has uninverted. And if you have been following my updates for some time, you'll remember we spoke about the impact of the inversion about, I think, 2 years ago. But now, as the Fed is beginning to go into its easing cycle, that has also normalized the yield curve, which in essence is a graphical representation of bond yields across different maturities or durations. So after more than 2 years of being inverted, which means short-term yields were higher than long-term yields, we are finally seeing yields on the short-term bonds fall below those on the long-term bonds, which started happening in early September. And this is how yields are generally expected to behave. And the upward sloping curve reflects the extra income that investors sort of demand or expect in exchange for locking up their money for longer with the government. And against this backdrop of the yield curve uninverting, strategists are encouraging investors to move out of cash and shorter dated bonds to capture those higher yields on intermediate dated products. So these could be maturities of roughly between 3 and 7 years. And they're also warning of the potential for an uptick in volatility in very long dated bonds, which can be quite sensitive to changes in economic expectations. So currently, this intermediate middle dated products are the sort of sweet spot as we begin to get more clarity about the way forward, as we're starting to see the Fed easing their monetary policies, but still a lot of uncertainty into the very long term future. And so, if you have kept a keen eye, you would have also noticed that the cash buffer held in the portfolio previously, which sometimes touched nearly 20%, is now almost non existent. Maybe overnight could be between 2 and 4%, but the money is almost always deployed at this moment in the portfolio. And finally, it wouldn't be, apt to talk about the market outlook without considering the risks. And when I did the last update call in May, we talked about how do we respond to those known risks. And we've seen a lot of these key global macroeconomic events in the second half of this year, and many of them to some extent have impacted the market and the portfolio, but have also done so in a somewhat predictable manner. So that's why we call them known risks. And I want to pause here and talk a bit about volatility in general, because as I said at the start of the call, is we are currently seeing the stock market at all-time high, which always begins the conversations around market corrections. When the stock market is at an all-time high, the market begins to get nervous and people start to gear up or speculate about a market correction. There are sort of a few points I'd like to make on this. The first is that volatility in the stock market is not always the enemy. In fact, it is a very healthy part of the market. It allows the market to reset, and for an actively managed portfolio actually provides opportunities to establish or increase exposure to a stock at a discounted price, which can be particularly true in cases where volatility is driven by sentiment or technical factors rather than fundamentals. So, yeah, don't fear volatility, partly also because this brings me to my second point, is that volatility is not only healthy, but it's also entirely normal. In fact, if we look at the period of moderation which we've seen after the global financial crisis, it was quite unusual for many reasons, and the muted volatility was amongst one of those. The VIX, which is the volatility index, historically has experienced much more dramatic gyrations than was the case after the global financial crisis, which was particularly subdued between 2012 and 2019. So we're almost just for I hate to use this phrase because it's so much linked to the pandemic, but even in the stock market, we are to some extent returning to a more normal environment where the VIX may experience more pronounced spikes driven by factors such as the Fed, geopolitical tension, and general proliferation of information, and nowadays, even more social media dissemination, which can arguably make investors more anxious and make markets less efficient. But again, not necessarily something to fear, because in an actively managed portfolio, um, inefficient markets are great opportunities to find stocks which are not efficiently priced. So it's actually a great opportunity, and it's why you would have seen people talk about the return of actively managed funds. This is one of the reasons. And the third part is that market corrections are not uncommon at all. Corrections of 10% or more have happened in 20 of the last 35 years, and the average drawdown in that time frame is around 14%. And despite these sort of continuous corrections, which we keep fearing, they happen. And despite that, we have seen the S&P return an average of 11% per year. So investors who stay on course through these bouts of volatility are really rewarded for their long-term commitment, and sometimes that discipline is the key to that reward, because as we saw in August, that change can come really quickly, and that's why the age-old saying about time in the market is more important than timing the market. So that is my it's an answer to a question many of you have asked me. So is there going to be a market correction? Market corrections are not uncommon. They are entirely normal. In fact, they're healthy, and they are a great opportunity to find inefficiencies in the market. So, the portfolio performance for this year has been, as I said, closely following the S&P 500. And for those of you who have been with me for some time would remember that in 2022, the portfolio really had a deep drawdown, and I have been working tirelessly um, to sort of regain the growth from there. Overall, as I said, over a long-term portfolio, you would have, since the 1st of Jan 2017, more than 2.5x your money that you have invested. And so that remains my long-term commitment to the portfolio. What I'm doing is working in terms of giving returns. And as you know, with any or elite pro or any popular investor, is that we very often have our own money invested. So our incentive more than anything is to make our money grow along with yours. I mentioned the strong investment thesis around risk management. And again, this is just to show how we have sort of maintained that low risk score on eToro to have more exposure to lower risk assets over the course of the last year. And despite doing that, I'm very, very proud and satisfied with the way that we've done it, because we are very closely following the S&P 500 with a remarkably different risk profile. And that's something which is hugely uncommon. And it's something that I believe retail investors who come to eToro should have access to those kind of returns without having to sort of stomach the risk that, that sometimes is unnecessary, in my opinion, if it's not well managed. So this is something that I'm very proud of and continue to actively manage in the portfolio. In terms of the portfolio composition, we are, as I said, a lightly blended portfolio. We have some exposure, more opportunistic to value stocks rather than it being a blended or a value driven portfolio. This is a growth stock portfolio, but there's nothing wrong in hedging your bets, and there's nothing wrong in trying to make gains when the market is rotating. And over the last few months, we have trimmed back heavily our exposure to tech, which thankfully happened before the laggards. And this is because in May we discussed how those stocks are somewhat overvalued, and brought us back to some more exposure, particularly to the financial sector, which was in anticipation for the interest rate cuts, but then also coming back to our original sort of love for healthcare stocks, particularly as I found more newer companies who are using AI in terms of disrupting the healthcare services. I've recently added Humana to the portfolio for exactly that reason. The stock had a small correction, which is a stock that I've been watching for a long time, but felt that it was apt to add it to the portfolio during that correction, because over the long term, they are doing a lot of what we call the plumbing for the future data infrastructure that would be part of their long-term business revenues. And so yeah, that's brought some more healthcare exposure back into the portfolio. Finally, to wrap up, going forward, as always, I will continue to do my scenario forecasting, do the dynamic readjusting, as well as keep the portfolio net long and keep my communications regular and transparent. From you, all I ask is that you expect volatility. As I said, we have gone back to a normal time of volatility. Review your portfolio and consider depositing when there is any corrections, or when you feel you have some extra funds. You might remember that I used to deposit monthly in my main portfolio. I don't do that monthly in my main portfolio anymore, but it is a very key attribute or habit of an investor, which I think sets up your tone and your seriousness for your financial journey. And finally, as always, I like to end off with my golden rule for investing, which is patience and discipline. And I thank you for joining me on this journey and allowing me to be the disciplined and patient driver of your investments, as you allow me to stomach those emotions some days and do nothing when nothing is the right thing to do. Because as an investor, when we feel those emotions, it can often be tempting to take action driven by emotion rather than by your key investment strategy or hypothesis. And that is where discipline is an incredibly key part of any long term investor. And just a final note to end off. As I said, remember about any deposits that you want to make monthly. I'm still depositing to my investments monthly. It's something that I take very seriously. And if you want to sign up for my mailing list, you can scan the QR code in the top. I have, as always, tried to incorporate any questions that have been floating around on my eToro page and elsewhere more naturally into the presentation. But if you have any further questions, please feel free to add them in the comments below. And I look forward to seeing you at the next update. Until next time, bye.